Hey guys, got a video for you today. Pretty interesting video. I'm gonna go over my A+ model and then kind of compare it to the inversion fair value gap model that I know a lot of traders use. They wait for an SMT divergence and then they use an inversion fair value gap for their entry. So kind of compare and contrast. As you can see in my execution this morning, we're gonna go over, do a little recap, and then see how that SMT diversion fair value gap model worked as well. Here you can see I took a sell right here targeting London low this morning. We have relative equal lows here as well, but then the day before we have also a London low there, which is just some more relative equal low. So a lot of sell side liquidity sitting down here. Key area to target. And then I know a lot of traders wait for SMT diversions. So here's our data high for the morning at 8:30. We have that data high. ES takes out that high. NQ fails to take out that high. And then we have that inversion fair value gap price then trades below it. So I know a lot of traders wait for that SMT divergence and then wait for price to trade below that inversion, and then they take a short once price closes below that, and then they probably put their stops at the high, and then they could be targeting these lows. Maybe they lit a couple runners to the London low, who knows, but most likely it's a 1-to-1 R. I don't necessarily like to trade 1-to-1 R's, but hey, it's a preference, nothing wrong with it. So I like to be a little more patient, waiting for more confluences. When I have a lot of conviction, that's really when I want to take the trade. Nothing wrong with this SMT divergence, inversion fair value gap model, whatever you want to call it. I like to wait for a little bit more confluence. So what did I wait for? My A+ model is me waiting for a breakaway gap, meaning that I like to wait for insufficiency to stay open. So when we have a sell side imbalance like this, first thing we can see price respecting that new day opening gap above, respecting that inversion fair value gap. Now I have a little bit more confluence that we are respecting that. Then we see a little bit displacement to what? This new day opening gap right here. So these new day opening gaps are insufficiency in the market. I like to use them to really build a directional bias. So what you can see here is I use it for an entry as well. Price trades up. What does it do? It fails to trade inside that fair value gap. Okay, and then we see more displacement to what? Inside that new day open gap. So notice how we reject right at that high of that new day open gap. Look at the bodies reject right there, and then we trade up. We create this bearish order block. I like to use the order blocks for my entry in this model. So we create a bearish order block here to then trade up but fail to trade inside that gap. We then displace lower inside the new day opening gap, and we trade to that midpoint. So notice once we trade inside that new day opening gap, we've left this insufficiency unfilled, entering as price trades to that high of that new day open gap. And notice that bearish order block, the low right there, is literally aligned with that high of that new day open gap. So I'm using that order block and the high of the new day open gap for my entry, and notice how I'm barely in any drawdown. And that's exactly where I want to get in the market, when we're expecting a strong sell side delivery and I'm not sitting in a trade with a big drawdown. Sell there, and then we see a strong sell side delivery to where? The London lows. And it's really simple. I'd rather catch this move than be in some drawdown, and hey, maybe you get it at a better entry because you're entering higher in the swing. So it's a better entry, but it's all about, I just need a piece of the pie. I don't need the whole pie, and I'd rather catch a little piece of the pie where I have more confluence and I have more conviction in the setup. So there's nothing wrong with this model. I'm just comparing. It's not my way of trading. I like to wait for more confluence, and I like to wait for insufficiency to stay open. And that's exactly what I'm looking for. And the trade would look something like this, more of a 1-to-2, 1-to-3 risk reward ratio. So you'll see you can either put your stop at that breakaway gap. You don't expect price to trade inside that breakaway gap. Or when we create a wick like that, you can also use consequent encroachment. You can put your stop just above that consequent encroachment. And I don't expect price to trade above this new day opening gap. Once we've ran inside that new day opening gap and we just touched that high and then we see a delivery, I'm pretty much at break even now. My stops has moved at break even. I don't expect price to trade back up there. If it does, then I don't expect a strong sell side delivery, but I'm anticipating a strong sell side delivery because of the confluences, because of the insufficiency that's staying open, because of the rejection we've had at that inversion. All that build up confluence now tells me that we're going to run pretty fast to that London low. So I hope that gives you pretty much a good idea of my model. The inversion fair value gap is a great model, nothing against it, but this is the difference of how I trade and what I've noticed most traders like to use with that SMT divergence and that inversion fair value gap. So I hope you guys enjoyed this video, and I'll see you guys next time.